This program is brought to you by the Kentucky Small Business Development Center in Louisville. We provide the professional expertise, tools, and resources to help you succeed. To connect with a business coach, call 502 625 0123 or email sbdcinfo@uky.edu.
Hi, welcome everybody. I'm Dave Etkin. Good to see everybody. Thanks for joining us on another Toolkit Tuesday. I'm joined here with Janet. Janet, how are you today? I know you hate when I do that.
That's okay. Sorry. Doing great today. It's nice and sunny, which is a nice change from yesterday.
Exactly. So welcome to another Toolkit Tuesday. And as always, just to make sure, and we do have our share of technical problems. If you would just look at the bottom of your screen, you'll see a toolbar. And if you don't see the toolbar, just take your cursor and hover down there. It should pop right up. There you'll see the chat feature. If you wouldn't mind, just type in, just so I know that you can see and hear me, just type in your name, say hello, and tell me where you're joining from. It's always great to kind of see where everybody is in the world, out there in the universe. And I appreciate you guys taking time out of your day. There's Victor from E-Town, Gwen. Hey, Gwen from Louisville. Stu from Shepherdsville. And Lily from Louisville. Hey, Nancy. Hey, Tiffany. Joan. Hi, Joan. Saw you the other day. Good to see you online here. Anya from Waldron, Indiana. Okay. Lexington. Hey, Johanna. Yep, so people are really populating in here. Hey, Anamana, how are you? Yep. So yeah, thanks for joining today. I know you guys are all busy, and so I appreciate that. Again, my name is Dave Etkin. I'm the director here at the Louisville Small Business Development Center, and I'm gonna go ahead and share my screen. We're going to get started because we've been talking about a lot of things these last few weeks towards the end of the year, about how to prep up for a 2023 and get things going. So one of the most important things that you can do is really drill into your financials and understand what they're telling you and use them to make better decisions. Janet, can we see that okay?
Looks good.
All right. So here's what we're going to try to do today in the short time that we have. And that is, I know we're really going to talk about what to do with your financial statements and that financial information, how to make decisions with it. But I'm going to take a step back first, and we're just going to breeze through, the financial statements that you should be getting on a weekly or monthly basis. Because you'll need these going forward. And, this is a two-part series. We'll come back next week and talk about some other things. So we'll need these statements to use to look at our business and make decisions with it. So that's part two of my agenda, is we are going to use these financial statements. We'll walk through them, tell you what to look for, and really, give you some tips and tricks on how to use that. Number three, third thing we're going to do is talk about break even, how to quickly calculate a break even. I've got a great spreadsheet that I've put together. I'll be happy to share with you. It is so easy to use. And once you know your break even, how to calculate it, you can use the spreadsheet to make decisions, lay out scenarios, see what works best, and use this to really drive your business to profitability. So that's the last thing we'll do. And again, my name is Dave Etkin. There's my contact info, and I'll put it up at the end. I'm always happy to talk to anybody. It's really fun for me to meet everybody and learn about your business and see what we can do together to really drive that thing forward. So let's get started. A couple things. Got to keep records. This is your tip. This is January. So again, we're laying the groundwork for a good year. Make sure that you keep all your records according to guidelines set forth by the IRS. It's very important to be able to get back on these things in case issues pop up. Also, you'll want to use some of these records to begin an analysis to see some trends as you move forward with your business. You'll need, going forward in 2023, you'll need records to obtain financing from banks and records. You'll need CPA, will need it for your tax returns. And mainly, you need it to track who owes you money and who doesn't and what you owe, and then to monitor your business trends, the most important thing. If you haven't done so, it's really important. We've noticed here lately that there's a lot of businesses that kind of let these things lax. So if you need any help to check your entity compliance, we'd be happy to do that. Make sure your LLC is in good standing. And you want to keep your business separate from you. Don't commingle personal funds with your business. Keep everything separate. That's tip number one here. And make sure going forward, if you don't do this, it's best practice, record everything. You got to keep good records. If you haven't done this, aren't doing this, or if you don't have a bookkeeper that does this or a CPA, make sure that you reconcile your bank account going forward. This is a January goal. And make sure that you get regular financial reports. This is part of the whole process of making a strong business is getting regular financial information. So that being said, let's take a look at what these regular financial reports are and what what you should be getting. So there are three major types, and they are the balance sheet, the income statement, or sometimes called the profit and loss, and then lastly, the statement of cash flows. And we need three of these for various reasons, but let's take a look at the balance sheet first. So the balance sheet is a statement at a point in time listing the condition of your business. So it will always have at the top, a specific date like December 31st, 2022, or June 1st, or whatever. It's just a single date. And it shows what the company owns in assets, anything of value, cash, inventory, equipment, accounts receivable, intellectual property, buildings, whatever. And then liabilities, what the company owes. Could be accounts payable. Those are things that you owe in your vendor, loans or debt. And then lastly, the capital investment or the owner's equity. What did the owner put in? What did the business generate on behalf of that owner? So there is a financial equation with all these, and it is in the balance sheet, it is assets equal to liabilities and equity. And this means that the assets are the things that make money for your business, and the liabilities and equity are how you got those. And assets are acquired just two ways. They're either through debt financing, and it could be through, vendor credit. Like, I call a supplier and say, send me 100 of these parts, and then their terms are that I don't have to pay for 30 days. Maybe that's their terms. So basically, they loaned me money to buy those parts, or loans from banks or other people. So debt is one way. And then owner's equity. So money that you invest as the owner, or the retained earnings. So the company itself will generate profits in cash. Instead of taking those out as an owner draw or some other things, you put those back in the business to buy other assets. So here is a balance sheet for a company. And so you can see that it is divided into what we just talked about, the assets and the liabilities, but also it's further divided into the types of assets and the types of liabilities. So on your balance sheet, and make sure that your bookkeeper, or if you're using QuickBooks yourself, make sure you take a look at this. Make sure you have it divided into current assets, which are things that will, from an asset standpoint, will be turned into cash within 1 year. So cash is cash, but accounts receivable, those are the amount of funds that our customers owe us. These are all things that we would, hope to collect within a year. And then non-current assets or long-term assets, these are things like buildings or equipment or things that, we'll keep on going. And the same with the liabilities. Liabilities are the bills, current liabilities are the bills that we'll pay within the year. And long-term liabilities might be mortgages or things on our building. And then lastly, how much did the owner invest? And then the retained earnings, which rise and fall based on the amount of money you as the owner takes out of the business. As we go forward, if you have any questions, as we kind of breeze through this stuff, I know I might generate a question or two. Just put those in the chat. And Jenna, if you wouldn't mind watching those for me, I can't see it from my screen at the moment. Oh darn, I forgot all about that. My bad. And then our income statement is it is a statement of the activities of the business covering a period of time, and that includes at the very top our sales and revenue less the cost of sales, which are the things that the company has to buy before they sell it, and then our expenses, which are all the other things, the salaries, advertising, whatever, and then lastly the net income, the things that we get to keep. And so that equation is the revenue is less the cost of goods sold equals the gross profit minus the expenses equal the net profit. So those three things are what we're going to talk about a little bit later: the revenue, the cost of goods sold, and the gross profit, because those things are key as we calculate our break even and make decisions. So, that net profit also, we can only do three things with net profit. We can pay owners with as part of an owner's draw. We can purchase new assets, things that we'll use to make money, or we can pay down debt. Those are the only three things that you can do with net profit. So it's like a fixed pie. So if you're paying the owners more, well, then there's less cash left over for purchase new assets or principal loan payments. So just something to be aware of. So here's our income statement. So you'll see at the top of your QuickBooks statement, you'll say net sales, which is the sales after any returns or allowances, or if you charge sales tax, it'll be after sales tax that is charged. Here's any selling expenses, all the other expenses that we see that we talked about. And then the operating income, kind of the profit before other charge-offs. And then lastly, we have the cash flow statement, and it is a statement covering a period of time that shows the cash coming in and out of our business. So in one portion of it, it'll say the cash receipts, from cash sales or payments or loan proceeds, any type of cash coming in out of your business. And then the cash going out could be, for debt or owner's draw or anything. And there's two types of cash flow statements, and it depends on how you set up your accounting system. One is the change of accounts. So let's take a peek at that one. So you can see here that it shows the change in activities, and those activities affect the amount of cash coming out of your business. So this is a little bit complicated. This is not my favorite. So if you look at the top, it'll show us our net income. We add depreciation back because, again, we're getting into accounting here, but depreciation is a charge that's a non-cash charge. So we add that back in. And then we add or subtract based on increases or decreases in these accounts, these cash accounts. So accounts receivable is the amount of money we lend to our customers to buy our goods. So if that increases, then it decreases our cash because we're putting inventory out. Same with inventory. So that we had to buy more inventory, and then accounts payable gets cash in as we collect that. So you can see this is a little bit complicated. This is the other way, which just shows total cash receipts coming in and the cash going out. This one makes more sense to me. So you can set it up either way, but I recommend going in this way. So do we have any questions out there, Jenna?
Nope.
Okay. Fabulous. All right. So the reason we have all these cash flow statements and income statements and balance sheet is because of the different types of accounting systems. And the most simple way is cash accounting, almost following your cash flow statement. The transactions are recorded when cash moves in the business, and it's recorded when it goes out of the business. So if I have a restaurant and somebody buys a sandwich from me, then I record that sale because they give me cash right then and then. A lot of businesses use what's called accrual accounting because Transactions are recorded when they occur, not when cash comes in and out of your business. So again, it may be that I'll sell items to a customer, but they don't have to pay right away. So the cash comes in later. And same for my vendors, I can order parts in, I don't have to pay for a period of time. So the cash doesn't match up with the sale. So that's why we use these different cash flow statements, the income statement, to track all these sales, make sure that they line up with when things happen in time. So let's put these two things together and see what it looks like for one period. So here's just a simple profit and loss statement. And we had sales of 200 and we paid some expenses. And we had the depreciation we just talked about. Here's our net profit before taxes. We had to pay taxes. And we had a net profit of $78. But if you think about it, these sales could be both cash sales or sales on credit. So again, somebody may have walked up and bought something and paid me for it, or I gave them terms. And same with the expenses. Maybe I paid cash for some things, and then other things I got on credit where I didn't have to pay right away. So let's look at what it looks like if we line it up on the same period with our cash flow statement. So in the same period, we received 198 on cash, and then we paid out 80, which could be, same with before, cash received, it could be from cash pay, cash sales at that moment, or it could be from some money that somebody owed me from 6 months ago. Same with the cash payments. And then we still have the same taxes. We have to pay taxes in cash because the US government doesn't give us credit. And so we have the operations generated $68 in cash. We had to pay our loan payment, which doesn't show up on our profit and loss statement, only the interest portion does. And then so our net cash is 41. So you can see we had a net profit of 78, but actually the company only generated a net cash increase of $41. So you can see why it's important to understand and have both of these cash flow statements. So now,
a couple of questions, Dave.
all right.
Okay, so one question from I believe it's Lisa. Lisa, what are the names of the accounting systems to purchase?
Oh, I can send you a list, but quickly. I mean, everybody uses QuickBooks. It's kind of expensive. It's a little learning curve. Here's a real secret, though. There's an accounting system that's free called Wave. We don't make any money by endorsing anybody, and we're really not supposed to endorse anybody. But I would check that out. Wave is free. It's waveapps.com, I think it is. So you can use that. Xero's great. FreshBooks. There's a lot of stuff out there that you can use. But if you're just getting started, if you have a smaller business, then you don't want to spend $80 a month or $30 a month, whatever it is, on whatever your version you use for QuickBooks. But I'll check out Wave. It's free for a bit. You get a little bit more bigger than you might want to go to a paid version for some other bells and whistles. But that's what I would do. I can send you a list.
We can maybe include that with follow-up emails.
Yeah.
The other question is from Nancy about how to figure depreciation.
Yeah, wow, that's a big topic. I mean, I could probably do a class on that. But anyway, the easiest thing to do on depreciation is you just go to the IRS website. They have some tables that you can use. But depreciation is, if you bought something let's say you bought a car or a truck for your business, I think the standard depreciation length is 7 years. So you would just take, if I spend I would spend $7,000 for a car, I would deduct $1,000 each year for 7 years, and that would be my depreciation schedule. That doesn't mean at the end of 7 years that car is worth zero. It'll be worth something, but this is all kind of accounting. So consult a professional, but that's the idea of that.
Okay, thanks, Dave.
All right, thanks, Jenna. So now let's, we just talked about the different financial statements, and so what we're going to do next is how to use the financials, and we're going to start with the income statement today. And so here we go. Everybody ready? Good. So here's a simple income statement for a company. And so we sell both products and services, as you can see. And then, just as we set up that whole equation, the income statement equation, we have our total revenue, less our cost of goods sold, then all of our expenses, and then finally we have maybe some taxes and our net profit. Does that make sense? So if I was to ask anyone out there watching, is this a good business? Is this a profitable business? Are we doing well? Would that be a yes or a no? Well, I'll say it makes money. It's profitable, but the problem here is that we can't make decisions based on a single number, can we? This just shows us a quantity, but it doesn't show us the quality of the number. So if we were owners in this business and the operating partner came to us and showed us this, and we would look at it and say, well, this is pretty good. If we come back the next month and we were going to look at the financial statements, what we'd want to do is compare, wouldn't we? We would lay these things out side by side. So the first thing I'd like you to do when you start to put your business, accounting systems together and the reports that you get, and just using QuickBooks as an example, it's very easy to check a box where you can lay out, 12 months, a rolling 12 months report, so you can see trends across the time. So that's what, you would want to do. So the next month, when we look at our business, we would compare to the next month. So what we can do is we'll compare these two, side by side, and let's make some assumptions. So if anybody sees any red flags here, let me know. I'm going to walk through this. So it looks like our total revenue jumped up quite a bit. Sounds great, doesn't it? But oddly enough, our gross profit went down a bit. And our wages have gone up. And our total expenses went up quite a bit. But maybe that's because of the increased revenue. But overall, our profit decreased by over half. That's alarming, isn't it? Now, if we were just getting these things month on month, we could say, yeah, we're still profitable, looks great. But because we can compare, now we can make some decisions. Now, we can also drill down a little bit more to see a little bit deeper, what is the quality of these numbers, by clicking another box into QuickBooks when we get our reports. And that is to add percentages. That tells us a bit more as we make decisions on where to drill down and figure out what's going on with this company. So again, here's our total revenue. And our total revenue is 100%, right? And then if we look at our cost of goods sold and our gross profit, so in May, our cost of goods sold was only 26%, and in June, it went up to 50%. So, if I think of percentages and 100% is $1, I hope this makes sense. It's kind of the way I think. So in May, for every dollar I sold, or every 100% I sold, it cost me 26 cents, but I got to keep in gross profit 74 cents. So in June, it cost me 50 cents, and I only got to keep 50 cents out of every dollar. So you can see, even though the sales increased drastically, what we got to keep in gross profit decreased quite a bit. That's a big red flag to drill down into. And our wages and salaries, even though they went up, actually as a percentage of sales, they dropped. So that's not a bad thing. And our total expenses, even though they did go up in relation to our total sales, they actually dropped. So that's not a bad thing. The bad thing is that because of what we just looked at, our net profit went down to only 11%. So every dollar we sell, we only get to keep 11 cents instead of 28 cents. So the problem is our cost of goods sold, isn't it? And that allows us to drill down and figure out what's going on by doing this comparison. So there's a lot of things we can do that that could change the cost of goods sold. Maybe our suppliers raised our prices. We did not. So now that even though we're selling more, we're keeping less. So we might want to look at that. There may be a bunch of different factors, but that tells us where to look and where to analyze and where to look for solutions to this problem. So is there any questions on that? Yep. Oh. Let's see, I can see this now, Janet. Would help me see sales versus cost per business unit. Yeah, you could do that. So you can arrange your P&Ls in a bunch of different ways. Whatever makes sense for you. In various industries, you might categorize your expenses by, by occupancy costs or, wages and salaries or things like that to help analyze it. That's totally fine. What we're doing here is trying to get information to make management decisions. We're not, really talking about, taxes or anything like that. So we're looking for information. Taxes are for another day. All right, so let's talk about some helpful tools. And the first thing is this break even that we talked about. And, we'll use our income statement to get the information we need to calculate that break even. And I know everybody's heard of break even. How do you do it? There's a bunch of different ways, but hopefully what I'll show you is fairly easy and you'll be able to use it quickly. So technically, what is break even? An accounting break even is the point where, expenses equal total revenue and there's no profit or loss. And really what we're doing is trying to figure out what is the level of sales needed to make a profit. With $1 more in sales, it's a profit. You might have heard of cost volume profit analysis. Sometimes a break even is called that, but to me, it's always break even. Just 3 easy steps. Classify your expenses according to how they behave, and then use that to calculate your break-even point. And then once you know your break-even point, you'll use scenarios to make better business decisions as we go forward. So here's the 5 terms you need to realize and know: variable costs, fixed costs, cost of goods sold, gross profit, and contribution margin. So we'll go through each one. Yeah, Tiffany, we'll send you some slides later on today. So here we go. So what's the difference? So variable costs that are basically the costs that happen when you make a sale. So if I'm selling, pens, for example, I have to buy the pens before I can sell the pens. So, that's a variable cost. It raises and lowers, increases or decreases based on the level of sales. You can also add other things in there that make sense based on the level of sales. So it could be commissions. If we have a commissioned salesperson, they don't get paid unless they make a sale. So that's part of the cost of that sale. Packaging or royalties if you have a franchise or something, or merchant fees, like credit card fees, things like that. Sometimes labor is included in cost of goods sold. So for example, if you're having someone, make a product or assemble a product for you, a piece good, that's part of it. So a lot of manufacturers use labor calculations as part of their cost of goods sold. And again, it's a variable cost. So the idea is if sales go up, this cost goes up. If sales go down, this cost goes down. If there's no sales, then there's no cost. That's the other distinction. And then and compare that with fixed costs and costs that occur, whether there's a sale or not. So, whether you make $1 or $1 million, the rent will be the rent, same with the insurance or debt or things of that nature. So those are the 2 distinctions that we need to know. So let's look at what to do with these things. Let's look at some formulas. There's going to be a lot of text on these screens, so I apologize in advance. And if you have any questions, really put them in the chat, and I'll just stop right away and kind of clarify this. So here we go. So what do we do with all this? So we calculate our variable cost percentage, is what we need, part of our calculation for break even. So we just divide our variable costs, our cost of goods sold, by sales, and that gives us the variable cost percentage. Now, we want to know our contribution margin, or sometimes it's called gross profit, but contribution margin includes all those other things we talked about, not just the product costs. It could be the commissions, all those other things. So contribution just margin is a good term here. So we just subtract percentages. So we know that sales are always 100%, and we subtract out the variable cost percentage. And that gives us our contribution margin. And then to calculate a break even, just quickly, is our fixed costs, whatever they are, month or year, divided by that contribution margin percentage, will give us our break even point in dollars. So in essence, we're taking dollars divided it by a percentage, and then dollars comes out. So here's a quick example. So business has sales of 500,000 with fixed costs of 250 and variable costs of 100,000, cost of goods sold. So we figure out our variable cost percentage first. So we take $100,000, that's our cost that of the products we had to buy. We divide it by $500,000, that gives us 20%. We get our contribution margin by taking 100% minus the 20%, that equals 80%. We take our fixed costs and divide it by the 80%, and that gives us $312 for the year and break even. That's quick. And again, that's just, I don't expect you to write all that down and understand that, because the spreadsheet I'll show you will make sense, but we had to kind of go through this to get there. This is probably something that you've seen, this break-even chart. And, when I was in business school and I was looking at this, I thought how crazy this was. I didn't even know what to do with it. And that's why this spreadsheet that I'm going to show you kind of makes sense to me and push me in that direction. The other thing that'll pop up is, what if you have, how do you, if you have a bunch of different costs, what do you do, when you're assembling a thing? So here's just an example of a sandwich. So if we calculate what it costs us, we have, ham, turkey, and lettuce and a bun. Each has its own cost. So the total cost is $356. So what is our sale price? So we take our cost of goods sold and divide it by the $7.99. That gives us our percentage of 45%. So the other thing is that, often we have various products with various costs of goods sold. So this is how we calculate cost of goods sold on one, multi-part product. We can also do the same with different items in this example. So what we would do is we would calculate each individual cost of goods sold for our different products. So you see that under the COGS column. And then we determine what part of our total sales constitutes that product sales. So our percentage of sale is 100%, always, that's our total sale. So we were saying that 80% of all our sales go to sandwiches, 10% is sides, and 10% beverages. All we do is add those up and get an average of that. So that's the number we would use when we calculate our break even, would be the 40%. So again, we would just go to our, I'm gonna skip that one. So once we know these things, there's a bunch of different things we can do. And when we get to the spreadsheet, we'll walk through a couple of those, but I just want to show you these. So if you want to know what the sales are needed to hit a specific profit target, here's a formula for that. We would just take our fixed cost plus our target profit divided by our contribution. That would tell us the sales that we need to hit. If we needed to if we wanted to add a new employee, so we come across this a lot. So we would just take our fixed cost plus the new salary divided by our contribution margin equals our new break even. So you can see how important this knowing your contribution margin number is. Margin of safety is another good one. I'll show you that on our spreadsheet. And then the magic number is a great number to know. If you know what your magic number is, you can just take your phone out and whip through this thing in a second. So the magic number times whatever you're going to do. I'm going to rent a new building. I'll just multiply the rent by the magic number, and it'll tell me exactly how much new sales I'll have to do in order to cover that expense. So here's a great example. A business has sales of $500,000 fixed cost of 250, variable cost of 100. And they want to add a new staff person at $50,000. So the magic number basically is our contribution margin. So we take $1 divided by 80%, so that's 1.25. So 50,000 times 1.25, that means we have to increase our sales by 62.5 before we make any money on this new employee. So that being said, I'm going to take a leap of faith here, and I'm going to jump out and open up a spreadsheet and walk you through it. And this is a spreadsheet that that I'll share with you guys a bit later. And hopefully this will work. Okay. What do you see, Janet? Can you see the spreadsheet?
Yes, I see variable costs and monthly fixed costs.
Okay, great. Okay. So this is part of the spreadsheet that I'm going to send you. And here's how easy this is. And once we know our percentages. And again, I've got this set up for, a restaurant. I think most people understand how a restaurant sort of works. So let's just plug in some quick numbers here. Are we doing on time? Okay, good. So remember when we calculate the food cost percentage on our sandwich, it was in our other products. So we came up with 40%. So that's all we have to do is we'll put our 40% there. Let's say I want to budget all my hourly labor for 25% of sales. I have a franchise, I have to pay 8%. I want to budget, again, on your variable costs, you can budget some things. I can put in some coupons or discounts. I want to budget 4% on advertising, and I want to maintain a 15% profit in my business. So that what I set up here is like for every dollar that I sell, I want to keep 15 cents of that dollar for profit. So if you look down here at the bottom, is this big enough, Janet?
Yeah, that's a little better.
Okay. Let me hit that again. All right. And so on this next column on the spreadsheet, we just put in our monthly fixed costs, not annual, monthly. So let's just put in some numbers. Let's say I'm paying $600 for a bookkeeper and $250 for insurance, $150 for legal. LG&E is $1,200. They are so expensive. And manager is $5,000. On that, have rent of $2,500. 50 on that. I've got loan payments of $1,500. 600 on trash. $1,100 on water. So here's a couple of things that you can add that I like to do is an emergency fund. So this is money that I want to build up in my business for the future, just for opportunities or whatever. So each month I'm going to budget $150 just to go into that. Now I can also do the same thing with profit on this side of the equation as well. So I can put in profits here. And then let's say I want to have at least do, $1,200 a month profit here. So you can see that our total fixed costs for the month are $13,000. We have total variable costs of $94,000. Gosh, that's a lot. What am I doing here? It's not going to be good. Oh, well, we'll keep going. Okay, I'm going to budget this down a little bit. Okay. So you can see that our gross margin, our contribution margin, so we see I have 100% of our sales, less our variable cost of 89%. That means 11% is what our contribution margin. That's pretty thin. That means we need to cover this 13,000. What is that? So down here, we can break even at 1.4 million a year, or 124,000 a month, or 28,000 a week, or 4,100 a day. So just knowing this number, this 4,100, I'll know whether I make money each day or not based on based on that number. If my sales were more than 4,100, I know I made money. If if it's less, then I know I didn't make money. And Lisa, yes, I said I would send this to you guys later on today. It's a great spreadsheet. It gets better too. This is just the first page. Even better. So,
Dave, we have a quick question too from Mary
uh-huh.
in the Q&A there. It says, looks like advertising can be variable or fixed. Please explain.
Yeah. So this is just, again, this is not accounting. This is just making decisions. So don't get caught up on what it should be. Do what works for you. So what I'm saying here with this 4% advertising is what I want to budget a certain percentage of my sales to go to advertising and promoting my business. I don't have to have anything here. I can just turn that to 0 and that's fine. I can, maybe I have fixed advertising. Maybe I would put it over on the fixed cost where, I pay a digital marketing company $500 a month to do advertising. So it's just a matter of how I want to set this up. So again, it's up to it's not up to you. This is just a tool to make decisions. And so the takeaway is here, once I put these assumptions in, and I look down here at the bottom and I see that now I have to make $1 million in sales, and I think I don't know if I can do that based on my business model now. That allows me to go up here and think, what can I do to change that? Can I reduce my food cost percentage? So perhaps I rework the menus and find some new suppliers, get some better products that are a little bit cheaper. Do whatever I can to reduce that. And let's say I can, instead of 40% blended food costs, maybe I go down to 30%. So if I plug that in, I can go back down here and I can see that reduced my annual break-even sales by almost $350,000 by making that change. So, that's the beauty of this, is using that to make decisions and figure things out. Same thing over here. Maybe I change accounting firms and I can get the same stuff done for 300, or a new insurance company for 2, and get a rent abatement, so it's only 1,500 for a while, and then I just somehow pay off this debt. So again, my break-even sales went down. So any dollar that I make above this, or any dollar I make above this on the daily, I get to keep. That's all profit. So if you remember just a minute ago, we were at 4,100. Now we are at $1,400 a day. So do you see how you can use this to make some decisions? Okay. All right. Time is short. Let's move on to our next tab. So this is our break-even scenario planner, where you lay things out and do just what we did. So, I can, this is, this is one scenario. I can put it side by side with another, just like we did on our income statement, based on the different changes that we can make, and lay these things side by side, and tell me what our break-even sales will be, and more importantly, what our budgeted profit will be for the year based on these various scenarios. That is, in essence, what this is from. I should probably, if you guys want to, do a one-on-one with me and we can walk through this with your business, be happy to do that. If you go to our website on the Coach Connect page, you can get on my calendar that way. But this is what's really fun, is using this to make these decisions. On scenario 1, you would kind of lay things out as you have now, and then really think through and drill down on these different expenses and these different business models to see what you can do on this. And then this last tab here, before we get to some Q&A, because we are running out of time. is these little calculators here. So, if we just plug in our target profit, our fixed costs, we can get our sales. What I talked about, the sales needed for a new employee, we just plug that in there. That'd give us that. So, if we want to have a target profit of $20,000 and our fixed costs were 250 and our contribution margin is 80%. That says that we need so that says that we need to have $56,000 in sales just to cover, this target profit. Same thing with the new employee. I'm sorry, this is probably hard to see, but I will definitely send that to you guys this afternoon. Let's see, is there any other questions out there? Let me put this up very quickly. There's my email address. If you would shoot me an email here in just the next couple of minutes, I'll send you that spreadsheet right away. You won't have to wait. Can you see that okay, Janet?
No, I didn't see that pop up in the chat.
Okay.
I did put your Calendly link already up there.
Thank you.
But we're going to do part 2 next week. Do you want to tell folks what we'll be doing then?
Yeah, so we'll go through some more tools where you, for scenario planning, we'll use some how to calculate ratios, so you can use that to monitor your business a bit closer. We'll talk also about how to use some of this information to build a dashboard for your business. A weekly dashboard is probably one of the best tools you could do for your business. And even if you're just a single solopreneur doing something, a simple dashboard where you calculate and track certain numbers will really drive your business forward. It's kind of incredible how that works. So we'll talk about that next Tuesday. Let's see. Is there any other questions, Janet? I don't see anything.
No,
Okay.
and we've got everyone's email address from when you registered for today, so we'll be able to send those out. You don't have to drop any more information in here. We'll have that already.
Okay. So a couple things that I want to just throw out there before we go. The 4 things I always tell people is that, ignoring information is dangerous. So make sure you get good financial information. Take the time. It's January. We're making new goals and new changes here. So take the time, to get good information. And again, next week, we'll talk about some ways to put that information in a format that will be fun to use and monitor your business. And then don't assume things, calculate, because a gut feeling is not a unit of measure. We need to know what's going on. And again, I'll just reiterate, demand regular financial information and use it to your benefit. And, most businesses that do this you'll see a lot more profit. You'll understand what's going on, and you'll be able to make good decisions for your business going forward. So that's all I have for you guys today. And I can't believe you guys took time out of your day to join me. I really appreciate that. You guys are wonderful. And I always enjoy talking to you. So please jump on my calendar. Let's go through that spreadsheet. That's really fun for me. I love it. It's fun. It's a good tool. And I really want to share it with you guys. So Janet will send you the slides later on today and a spreadsheet if you, so we'll have that. So that's all we have today. Janet, anything else we need to add?
No, we'll see everybody next week.
Okay. Bye, everybody. We will see you next Tuesday.